Fellow Singaporeans, which one should you own right now? YLD, the new APAC Financials Dividend ETF shaking up the SGX, or CLR, the battle-tested S-REIT ETF that owns our malls, offices, and data centers? One gives you exposure to DBS, OCBC, UOB, and Asia's biggest banks. The other turns you into a mini-landlord of Vivo City, Mapletree Business City, and even data centers. Which pays you more? Which is safer if the Fed keeps cutting rates? Stay till the end because I'll reveal which one might deserve a spot in your portfolio, or why holding both could supercharge your passive income strategy. Like seriously, this could be a game changer. Like this video so more Singaporeans can learn to build cash flow-rich portfolios, and subscribe to Wealth for You for weekly dividend and CPF insights. Disclaimer: this video is for education and entertainment purposes only. It is not financial advice. Markets go up and down, dividends can be cut, and past performance never guarantees future results. Always do your own research and invest within your risk tolerance. Chapter 1. What is dividend investing and what is an ETF? Before we dive into YLD versus CLR, let's quickly cover the basics. Because if you get this right, the rest of your portfolio will make so much more sense. Dividend investing is about building a portfolio that pays you regular, predictable cash flow, not just hoping the stock price goes up. Think of it as planting money trees that drop cash every quarter or half year. Cash you can spend, save, or reinvest to grow an even bigger future income stream. Over time, these payouts can become your financial engine, covering copay sessions, bills, or even your retirement lifestyle. Now, what about an ETF? ETF stands for Exchange Traded Fund. Basically a ready-made basket of stocks or REITs that you can buy with one click, just like a single stock. Instead of buying one bank or one REIT at a time, you instantly own a whole basket of them. This gives you instant diversification, helps reduce risk if one company underperforms, and saves you the headache of tracking and rebalancing multiple counters yourself. So, dividend investing plus ETFs is an easy, low-maintenance way to start building cash flow-rich portfolios without the stress of stock picking every day. Chapter 2. YLD and CLR. Now that you know what an ETF is, let's meet today's two stars of the show, because they couldn't be more different. First up, YLD, the Lion-OCBC APAC Financials Dividend Plus ETF. This is the world's first ETF that focuses purely on Asia-Pacific financials. It holds 30 of the region's biggest and most tradable financial institutions. So when you buy YLD, you instantly own DBS, OCBC, UOB, HSBC, Sumitomo Mitsui, Mizuho, and even the big Australian banks like Commonwealth Bank, NAB, and Westpac. Instead of betting on just one bank's performance, you're spreading your risk across multiple banking systems. From Singapore's rock-solid balance sheets to Japan's scale and Australia's high dividend payouts. Then we have CLR, the Lion-Phillip S-REIT ETF. This ETF is like buying a slice of Singapore's property market in one click. You get exposure to top REITs like Capitaland Ascendas REIT, Mapletree Logistics Trust, Keppel DC REIT, and CICT. That means you indirectly own malls like Vivo City, office towers like Mapletree Business City, logistics warehouses across Asia, and even high-tech data centers powering the digital economy. Think of it this way: YLD turns you into a regional banker, collecting dividends from Asia's biggest financial giants. CLR turns you into a mini landlord, collecting rent from some of Singapore's and Asia's most prime properties. Two very different ways to build passive income, and in this video, we'll figure out which one fits your strategy or if you should actually own both. Chapter 3. Exposure and Diversification. Diversification is one of the most important things in investing. And this is where YLD and CLR take very different approaches. YLD gives you exposure across 5 major markets: Singapore, Japan, Australia, China, and Hong Kong. That means your dividends aren't just tied to one economy. If Singapore slows down, maybe Japan or Australia pick up the slack. But remember, while YLD is geographically diversified, it's still 100% financials: banks, insurers, and financial institutions. If the financial sector as a whole faces stress, say a credit crunch or rising loan defaults, YLD will feel the pain across all markets. CLR, on the other hand, keeps you mostly in Singapore, which means you benefit from Singapore's strong regulatory environment, clear REIT rules, and relatively stable economy. But it spreads your exposure across different types of properties: retail malls, Grade A offices, logistics warehouses, business parks, and even data centers. This means that even if one property sector suffers, like retail during COVID, others like logistics and data centers can keep your dividends flowing. So think of it like this: YLD is sector concentrated, regionally diversified. You're betting on the strength of financials across Asia-Pacific. CLR is country concentrated, sector diversified. You're betting on Singapore's property market, but spreading risk across different types of real estate. Both offer a form of protection: YLD against country-specific shocks, CLR against sector-specific shocks. And that's why some investors choose to hold both, to balance out the risk. Chapter 4. Dividend Yield and Payout Frequency. All right, here's the part that, honestly, most income investors really care about. How much do I get paid and how often? So let's break it down. YLD is currently trading at about $1.28, and its trailing yield is roughly 5.29%, paid out quarterly. That means every few months you'll receive a payout. To make it a bit more real, if you hold 10,000 units of YLD, one of its recent quarterly payouts, back in July 2025, was 3 cents per unit. That would give you about $300 for that quarter alone. Over a full year, similar payouts could generate more than $1,200 in cash flow, which is enough to cover quite a few recurring expenses, or be reinvested for even more income. Now, CLR is trading around 87 cents, with a trailing yield of about 5.55 to 5.7%, and a forward yield of around 5.32%. It pays semi-annually. That's usually in February and August. So if you own 10,000 units of CLR, one of its semi-annual dividends was 2.3 cents per unit for the recent payout. That's about $230 for that half year. Over 2 halves, you might expect somewhere between $460 to $550 or more yearly, depending on how stable the payouts are. So, here's the trade-off. Just looking at the latest figures. YLD gives you more frequent quarterly payouts and about a 5.29% trailing yield, which is great if you want more regular income streams. CLR, on the other hand, gives you fewer payouts per year, but with a slightly higher trailing yield, around 5.5 to 5.7%. Good for those who prefer bigger lump sum income events, with the stability that comes from property-based assets. Either way, both these ETFs help deliver actual cash you can count on, not just paper gains, as long as the payouts hold steady. Oh, and just an important note here. Your yield will always depend on 2 things: the price you pay and the dividends the ETF declares. If prices go up or payouts get cut, your yield will drop, so always check the latest numbers before you buy. Chapter 5. Performance and Track Record. Okay, let's talk about performance, because let's be honest, we all want to know if these ETFs have actually made money for investors. YLD is the new kid on the block, launched in May 2024, and it has really come out swinging. In just over a year, it's delivered a total return of plus 24.7%, and that includes both price gains and dividends. That's a pretty impressive start. especially for a financials-focused fund, showing that banks and insurers across Asia-Pacific have been doing well, thanks to strong markets, healthy balance sheets, and solid dividend payouts. But just keep in mind, YLD is still untested in a major downturn. We haven't seen how it performs if there's a regional banking crisis, or if global credit markets suddenly tighten up. Now, CLR, on the other hand, has been around since 2017. That's more than 7 years of history. During that time, it's weathered COVID lockdowns, interest rate hikes, inflation scares, and even market corrections, and it's still kept paying out steady dividends. Its total return since launch works out to about 2.6% annualized. But remember, the majority of that return comes from cash flow, not price appreciation. CLR is designed to be slow and steady, the kind of ETF you hold through thick and thin, collect your dividends, and just reinvest for compounding. So, to sum it up, YLD gives you a strong debut, higher growth potential, but it's still unproven under stress. CLR is battle-tested, resilient through multiple market cycles, and really just a reliable workhorse for income investors. One gives you excitement and growth potential, the other gives you comfort and predictability. And depending on your style, you might want both in your income portfolio. Chapter 6. Risks and Red Flags. No investment is risk-free, and YLD and CLR each come with their own set of red flags that you must understand before buying. First, YLD. It's fully invested in financials, banks, insurers, and financial services. That means if we hit a global slowdown, credit defaults rise, or loan demand collapses, bank profits could take a big hit. And when bank profits drop, dividends are often the first thing to be cut. Remember 2008 and 2020. Banks around the world were forced to slash or suspend dividends. YLD would feel that pain across Singapore, Japan, Australia, China, and Hong Kong all at once. Now, CLR. This is your gateway to Singapore REITs, but REITs are very sensitive to interest rates. When rates go up, REIT borrowing costs rise, leaving less rental income to be paid out as dividends. Higher interest rates can also cause REIT prices to fall, compressing your portfolio value even if distributions stay steady. And don't forget property-specific risks. An office oversupply, weak retail spending, or unexpected vacancies can all pressure REIT earnings and payouts. Lastly, both ETFs charge a 0.5% expense ratio. It might sound small, but over 10 to 20 years it quietly nibbles away at your total return. So it's a cost you should factor in. Bottom line, YLD and CLR are great tools for income, but don't be blinded by yield alone. Understand the risks, size your positions wisely, and always diversify beyond a single sector or asset class. Chapter 7. Fed rate cuts and what they mean. Everyone is watching the U.S. Federal Reserve right now, and rate cuts can have very different effects on YLD and CLR. For YLD, lower rates mean banks earn less on their loans. Their net interest margins shrink. That could hurt profits and put pressure on dividends. But it's not all bad news. Cheaper borrowing costs often spark more housing loans, car loans, and business lending, which can boost volumes and partly offset the squeeze. For CLR, this is where it gets exciting for REIT investors. Rate cuts usually mean lower financing costs for REITs. That means less money goes to the banks, and more money can be returned to you as distributions. Plus, when interest rates fall, income-hungry investors often rush back into REITs, pushing unit prices higher. So, in a rate-cutting cycle, CLR might enjoy a double boost: higher investor demand and healthier payout sustainability, while YLD may feel some margin pressure. Bottom line, Fed rate cuts aren't good or bad in isolation, but they could tilt the advantage slightly toward REITs in the near term. Chapter 8. Mindset for Long-Term Singapore. Income investors. This is where we zoom out and talk about the mindset that really matters. Being paper asset rich isn't the goal. Anyone can hold $1 million condo or see a 7-figure portfolio on their statement. But that doesn't mean they can quit their job or sleep peacefully at night. The real goal is to be cash flow rich. Imagine your dividends paying for your groceries, your copay, your bottom weekend trips, and still leaving enough to reinvest for an even bigger payout next year. That's financial freedom, where your money works harder than you do. So whether you choose YLD, CLR, or both, take a long-term view. Think in decades, not weeks. Don't panic when markets dip. Reinvest those dividends, let compounding do its magic, and you'll wake up one day with a portfolio that funds your life. Final thoughts. So, which one is better? YLD is your quarterly income machine, regionally diversified but focused on financials. CLR is your semi-annual property landlord, Singapore-focused but spread across malls, offices, and data centers. And here's the secret most investors miss. You don't have to pick just one. Hold them both and you smooth out your cash flow across the year, diversify your income sources, and build a portfolio that grows more resilient over time. If you found this video useful, smash that like button so more Singaporeans can see it, share this with a friend who loves dividends, and subscribe to Wealth for You for weekly insights on CPF strategies, REIT investing, and dividend-driven financial freedom. Comment below. Which one are you buying? YLD, CLR, or both? Let's start the conversation and help Singaporeans grow a cash flow-rich community together.